Let's get in. Mayuresh Joshi, he is the head of research at William Neal, India, into the conversation, who looks at these stocks. Mayuresh, good morning and thanks for joining in.
Morning.
Before I get across, Mayuresh, let's talk about the first stock, and that's ACC. We've had earnings come through, and in terms of earnings for the quarter gone by, they've seen a decline of 37% in terms of revenue and a net profit decline of around 41%. When margins have held because of lower freight power and employee costs, according to the management. But Mayuresh, uh, if you can come in on ACC, what's the way forward here, according to you?
Morning, Agam. So first of all, I think the expectations in terms of Q1 numbers, they were expected to remain extremely soft because of lockdowns and the partial resumptions of their plants. And it's not just for ACC, it's for the cement sector as a whole. I think that is where I think the crux is when it comes to Q1 earnings. When we largely look at the landscape going forward, the expectations largely laid out in terms of Q2 are also expected to be on the softer side because of monsoons, and the progress of monsoons pan India actually hampers a lot of the execution activities. So the entire logic in terms of the second half recovery, that is the basic premise that is set up for cement companies. Now, when it comes to the expectations that were laid out and what the management has put forth, I think it was largely a weight in terms of the expectations that the street had. The EBITDA performance was very good, and you're absolutely right. I think a little bit of higher prices in terms of end products, a better product mix, and when you're probably talking about lower power and freight costs as well, and the lower discounting factor, I think that aided the operational performance in terms of margins sticking around 20.13%. Now, the second element in terms of the capacity utilization for the sector as a whole, and as these plants are ramping up slowly and steadily, as the stocking is also happening at the distributor and the dealer end, the second half and the expectations thereof in terms of infrastructure spending, specifically on the domestic side, and the cement prices, if you probably look at how the cement pricing has been across the country, I think they've largely held up on a YOY basis across, so whether it's north, west, south, east. But the majority part in terms of infrastructure building is expected to happen in the north and the west. So again, I think companies operating out of these regions might actually entail the benefit and the tailwinds of higher prices going forward as demand normalizes, capacity utilization comes back to that 65, 70 odd percent across its plants. And therefore, I think the operational performance in terms of reported EBITDA and the volume growth, which is expected to normalize, the EBITDA per ton should also start reporting better numbers, both on the realization side improving and the input costs going down. So yeah, it's a good set of numbers. I think the rub-off effect will be seen not just on ACC, but the entire cement sector.
Okay, fair enough. We keep an eye on ACC and, of course, the entire cement space, as Mayuresh has spoken about. But moving on to Interglobe Aviation. Now, we understand that Indigo has come up with another company statement where CEO Ronojoy Datta has said that, well, they're hardly flying a very small percentage of the planes, the 250 odd airplanes that they have, and they are looking to cut 10% of their workforce. While this may be a move which will mean that it will be saving on some costs, the overall picture doesn't really bode well, considering it's clear that at this point in time, it's not just Interglobe Aviation, but the entire world aviation industry is struggling, because if it's with Indigo, that means it's the case with many other airlines. Mayuresh, come in on this latest development, perhaps on expected lines, given the kind of pressures that these airline companies are seeing. What's the way forward for Interglobe Aviation?
No, you're absolutely right, and it's very unfortunate because of the pandemic. I think the obvious hit and impact has come on these aviation companies, not just locally, but globally as well. So if you're probably looking at constraining their operational costs, I think a lot of global companies are also resorting to the same measures that Indigo is going through at this point of time. If I probably look at the expectation thereof, and it's simple logic at this point of time, I think we know how international flights are going to resume. Domestic flights have started off. The utilizations or the load factors have been pretty decent so far. But again, if you probably look at the the entire pre-COVID levels and then what will happen in terms of the expectations for those levels to come back again. I think it might take some time, and there's a lot of uncertainty involved in terms of when those numbers will get achieved. The second aspect for aviation companies, including Interglobe Aviation, is that a large part of their input costs are fixed in nature. So almost 40 to 50% of their input costs, which are fixed in nature, does have a significant impact in terms of the overall yields that these companies report. Because of the pricing pressures that will still continue for some length of time, and because of the capacities which need to be carried out in a constrained manner as per rules, and input costs, as I said, because of the fixed nature of around 40 to 50%, that takes a toll in terms of net yields. Now, what happens also in terms of a lot of aircraft addition, the A320neos specifically, I think that is expected also to phase out and then see how these developments take place. And fourth, I think in terms of EBITDA margins, I think those margins are expected to remain on the softer side, assuming weaker demand environment, and then the logic in terms of how the entire scenario will pan out. From a balance sheet perspective, at least it is better placed compared to its peers. But again, I think for the sector as a whole, I think all these uncertainties will still play out in terms of prices actually not doing anything because of numbers not actually improving on an annualized basis.
Enough, and that does make a lot of sense. Well, it is a sector which is under a lot of pressure. But we move on finally to the power sector. Now, there is, well, two stocks which are in the news. Firstly, there's NTPC, because it's actually landed up commissioning another 800 megawatts of for Lara super thermal power project. And this takes the company's installed capacity, the group's installed capacity, to around 62,910 megawatts. And the other company which focuses is Tata Power. Its coastal Gujarat Power arm has allotted NCDs worth 350 crores. Now, these are just two of the many news, that have been coming through over the past few days. Mayuresh, take us through what your view is on the Indian power sector in general, and if investments in the power sector are or could have potential for growth going ahead.
So it's a very tricky sector, Raghav, very frankly. And if you look at the entire chain, right, power generation, transmission, and distribution, I think it's an entire chain that one needs to look at in a very holistic manner. When you're talking about the thermal power capacity at this point of time, the expectations that still get added up, and the government focus in terms of renewable energy. So what we've seen in the recent past and the expectations in terms of solar, wind, and hydro actually taking precedence over the next few quarters and years, I think that is one thing that is going to be a given. Now, the second element in terms of this entire power chain and the arguments thereof, what the Exchequer has done a few weeks back in terms of authorizing PFC and REC to disburse 90,000 crores, I think that would be a big relief. Because what had happened, that the entire power chain was getting choked up because of the non-payment provisionings that were actually happening. Now, as this money starts getting circulated, what happens in terms of the receivables for a lot of the state electricity boards, who then can pass it on in terms of the generators itself. A lot of balance sheet constraint which had happened in terms of leverage building up, working capital constraints building up, that should start getting resolved over a period of time. The third element, obviously, is the demand-supply dynamics itself. Now, the demand-supply dynamics obviously are going to remain very, very positive, because we still need power, and the expectations in terms of the per unit costs that we can deliver, assuming the input costs of producing power, I think that is where the entire argument was. Therefore, I think the High Court judgments in terms of upholding certain elements in terms of certain plants and some pullbacks which have probably happened, I think that is something to be watched out as well, because ultimately I think the input cost in terms of how coking coal is placed and ultimate tendering in terms of the final price that they can quote, I think that creates a huge difference. The fourth element, obviously, is a lot of leverage on company balance sheets. So again, I think in terms of cash flow remaining extremely sticky for all these companies in general, what probably happens in terms of the interest payments, I think that becomes very, very critical as well. So yeah, I think the power sector is very delicately poised on all these factors and elements bound together. Renewables is a given at this point of time, but look at the rates in terms of the renewable end pricing as well. I think the last quote that I saw in terms of solar pricing was anywhere between 2.3, 2.5. So I think with a lot of imports still happening in terms of solar panels, solar cells, and the entire concept of Atmanirbhar, I think as we become more self-reliant and as that price discovery starts happening a little bit more realistically in terms of end prices, I think a lot of private players will then probably see a lot of sense getting into this sector by putting in a lot of capex if it ultimately has a ROIC or a ROCE component embedded to it, which probably is absent at this point of time. So the regulation in terms of an electricity regulator, the electric exchange that we're talking about, the transparency will also be a huge positive if that happens over the next few quarters as well. So I think to summarize, delicately poised, but if executed well, I think private players will find a lot of value going.
Okay, fair enough. Mayuresh Joshi, we leave it at that. Thank you so much for joining us and taking us your views on the stocks that we've addressed.